The Big Short's Michael Burry is setting his sights on a new target, Tesla. Burry says the stock is, quote, ridiculously overvalued and has been for a good long time. But my next guest says Burry could not be more wrong about Tesla. Let's bring him in, Arbor Financial President, Jeff Small. Okay, Jeff, why is Tesla a winner for you?
Well, for lots of reasons, but, Tesla's valuation, and there's been so much in the press about Michael Burry wanting to shorting Tesla. He's been shorting Tesla since 2021. But Tesla's valuation is really tied to the optionality of its company, and its values really aren't based on what Ford's or GM's are. The market prices are much higher because of their optional businesses like autonomous driving, robotaxi networks, humanoid robotics, AI, compute rentals, energy storage and grid services, and software margins versus hardware margins. And so even if one of these optionalities hits at scale, the valuation math really changes completely against somebody like a Michael Burry. And that's why the stock, bottomed at 390. Now it's back up to 430, back to where it was trading in that range. And historically, Tesla has defied every major bear market prediction. And bears have repeatedly mispriced Tesla's execution ability. And I think, I don't know why Burry's getting so much attention for this. He's been shorting the stock for a long time now.
Well, because of his call back in '08. But I hear you. It is really hard to bet against the genius of Elon Musk. I remember it was about a year ago. I said on the air, I was like, Tesla is not a car company. It's an AI company. It's a robotic company. I got beaten up all over social media, and now that's exactly what you and many people are saying. That's what the company is. Sticking with the idea of shorting stocks, the research firm 22V says shorting U.S. stocks right now is dangerous because of all the consumer spending on and investments in AI. What do you think?
Well, I'd agree with that, but it's dangerous for many other reasons. Quantitative tightening just ended, and when quantitative tightening ends, liquidity becomes flush and higher market cap stocks do better because the long-term rates seem to get suppressed. And now we're going into a dovish environment. I see a lot of bullishness coming down very quickly, especially if the Fed lowers rates on the 10th, which everybody's betting that that's going to happen. But there's always the chance, of course, that the rate cut is not a sure thing.
Yeah. And then how many rate cuts do we get after December the 10th? Would you say that the Fed is the one who is really holding the reins to this potential Santa Claus rally?
Oh, they are for sure. The last 2 years, Jerome Powell has ruined the Santa Claus rally with his mid-December meetings. And I would not be surprised at all with his consistency as such, despite the current data or the lack of data that we have from a transparency perspective, because really the Fed has suboptimal economic data to lower rates on the 9th and the 10th when they meet of this December. And so, it remains to be seen, but I kind of feel like rates are not going to be cut in December, and that will squash the Santa Claus rally.
Are you calling Jerome Powell the Grinch that stole Christmas?
He's been a consistent Grinch. Nothing against Jerome Powell, very astute man, brilliant man. But, in some ways, I think a lot of us agree that the Fed is mismanaging monetary policy here, and they're behind the curve.
Yeah.
And there's many reasons for that, but we don't need to get into that today.
Let's talk about the curve and AI stock valuations. A lot of people are saying we're potentially in an AI bubble, but you say the complete opposite, and you're actually finding deals to be had in artificial intelligence stocks. Which AI stocks are cheap right now, Jeff?
Well, I think I call them the Magnificent Six minus Tesla, because Tesla's fundamentals really are, 200 to 300 times earnings is kind of ridiculous. To buy a stock like that, unless you believe in their optional businesses. But the Magnificent Six are trading at a multiple much lower than the broader market when compared to earnings growth. Okay, so it's really simple math. Forward earnings is around 29 times earnings for the Magnificent Six minus Tesla Magnificent Seven. Forward earnings for the broader markets are around 23 times earnings in 12 months. But obviously the Mag Six are growing at 3 or 4 times their bottom line, their net profit, and their top line compared to the rest of the broader market. And so I think the real risk for the modern day Main Street investor is the broader market not performing if things get harder economically next year.
I didn't think of it like that the Mag 6 are actually not as highly valued as I guess I imagined. As we gear up for the new year, what stocks should investors hold in their portfolio in 2026?
Well, the global emperor of artificial intelligence is Nvidia.
Yeah.
And I think that you have to purchase the stock now at these current dips. You may not ever see it again at these prices going forward, especially with their guidance for next year exceeding 60% earnings growth for 2026, just like they did this year at 62%, which they blew out earnings recently, and then they gave great guidance for what's coming in the first quarter of next year. And so I think you've got to take advantage and buy the stock and be a longer term holder. Don't look for that excessive growth where we have, 30, 40, 50%, 100% returns in the first year. Hold it long term, because they are the future of artificial intelligence here, and they're the central computer for the planet as far as everything that they're doing to enhance artificial intelligence and its movement going forward into, robotics and governmental systems and omniverses and all the like.
Yeah, Jeff, thank you very much. And I'll add that Nvidia is at 181. 212 is the recent all-time high, so it's technically cheap right now. Management said today they expect to see $4 trillion in spending on AI infrastructure by 2030. That's 4 years away. Jeff, thank you.
Thank you.